Good evening, good afternoon, and good morning to everyone. Thank you for taking your time to join us on this webinar. Today's discussions will be about the role of central banks and financial regulators in managing climate risk. Joining me on this, my name is Kwame Antwi. I'm your moderator for today's section. I am an ex-investment analyst. I'm a business consultant, and I'm also a market commentator here in Johannesburg, South Africa. Joining me today on this panel are seasoned experts, financial market experts and economists who will be joining us to discuss this very important topic. As we've discussed previously in our other sessions, climate change will be the biggest challenge of our times, and how we as a generation or as a society tackle the impact of climate change will significantly shape the world that we will live in as we grow older, and also the world that we will hand over to our descendants. So without further ado, let me read a little bit of housekeeping rules, and then after that, I will introduce the speakers, and then we will go into the webinar. This event is being streamed live on YouTube. The event will be recorded and be played at a later date. Participants, except the speakers and the panelists, will be in listen-only mode. Each participant will speak for about 15 to 20 minutes. They have all prepared formal presentations that they will take us through. After each presentation, we may give a minute or two to clarify any issues that people want addressed. After all the speakers have spoken, we will open the floor for question and answer sessions. In general, the speakers cannot ask questions by speaking. If you want to ask a question, you press the Q&A button, and then you ask your question, and I, the moderator, will read your question to the specific speakers. I therefore suggest that you direct your questions at a particular speaker, and if it's all for all the speakers, also highlight it. Before we start, before I introduce the speakers, I want to take the opportunity to thank NOTWA International for setting up this wonderful series of webinars. I also want to thank the University of Oxford and also the World Bank for assisting in this event. Today, joining us on the panel of speakers is Pier Paolo Grippa. He's a senior economist at the International Monetary Fund, the IMF. He's also in the Capital Markets Division. He is also joined by his colleague, who is Peter Windsor, who is a financial sector expert. I understand he knows a lot about the insurance sector. And Pier Paolo will be talking about central banks and the role of climate change from a financial regulator perspective. And then also joining us as well is Prashant Vazi. I hope I got the name correct. He's head of policy and government at the Climate Bonds Initiative. I also understand that he's also head of India. So gentlemen, welcome, and thank you very much for taking the time to join us. In terms of the webinar, we're going to open the floor to Prashant. He's going to start. Prashant will join us for 45 minutes. He has prior engagements that he needs to attend to. So after Prashant's presentation, we will open the floor for about 5–10 minutes of questions before Pier Paolo and Peter will speak. So without further ado, I'll open the floor to Prashant. Prashant is going to talk about the range of actions that central banks can take to help mitigate climate risk in terms of promoting investments that will drive a green economy. I open the floor to you, Prashant, and thank you.
Thank you, Kwame. That's very kind of you to offer and introduce me so generously. And I'm very, very grateful for NOTWA International for hosting this wonderful event. Welcome to everybody in Africa. I'm speaking here from rather cold and chilly summer's day in London. I should explain a little bit about Climate Bonds Initiative, so for people who aren't so familiar with the organisation. We're a small not-for-profit that's based out of London, but we have activities in Southeast Asia, China, a member of staff who works in Africa, and also we have offices in India and LATAM. Our mission is to try to drive up the amount of investment in green infrastructure, and we are probably best known for a certification system that we run, the Climate Bond Certification, which is used to label bonds that have been issued that are suitably green and we think are consistent with the Paris Agreement objectives. And I myself am heading up the policy work, and I used to be a civil servant in the UK, and I've also worked in the Hong Kong government as well. Well, why am I here? Why am I talking about central banks? So I think my role in this discussion is really to set the scene a little bit and explain what is it central banks do, why they're being enlisted to help in this fight against climate change, and then talk a little bit about the kind of stuff that they have been doing. And just to give it some kind of historical perspective, central banks have obviously, their core role has nothing to do with climate change, but really, probably for about 3 years now, they've become quite active in this field. And really it's been driven through actions that have been taken, resulting from a meeting that the G20 held in China back in late 2017, when Mark Carney, who at the time was the governor of the Bank of England and the chief economist of the PBOC, Ma Jun, got quite involved with various activities which they kicked off, which included setting up the task force for climate-related financial disclosures and also the NGFS. And I'm sure many of the people in the audience will already know these institutions. So that's by way of a very quick background. What I'm going to do now is spend a bit of time talking about various things that central banks can do to help. So just to remind ourselves what central banks are there for, in most countries, their primary responsibility is to try to sort of limit inflation. And in many countries, they actually have targets of what inflation should be. It's normally a band between something quite small, like 1%, and something somewhat higher, 3 or 4%, at least in OECD countries. And they do this by setting interest rates, deciding how much reserves banks have to maintain. Together, these are there to influence the amount of money in the economy. And in some countries, they also have a big say in deciding how banks lend. This isn't so common in OECD countries, but it's certainly quite common in the emerging markets like Bangladesh and India. And I'm conscious that some people at University of Kenya are doing a similar kind of exercise to find out what's taking place in some of the African countries. The other major role that they have is safeguarding the financial system. And especially after the last financial crisis in 2007-8, that's very much risen to a fore, where people in society at large are very concerned about the failure of banks, and not just this failure of the banks themselves, but how they can drag down the rest of the economy. And this is called macroprudential regulation, and this is looking at whether the financial system as a whole is operating well. So whether banks and insurance companies, through ceasing to lend, ceasing to insure, they can actually make other economic activities unviable and drag down the economy. The third main action is the supervision of individual banks and individual financial institutions. And this is called microprudential regulation. And this is a fairly interventionist type of regulation, where they go in and work out whether a particular bank or a particular insurer is liable to fail. And they do this by quite intrusive reviews of what kind of assets they hold and what kind of loans they're making, and whether they've got sufficient capital set aside. And I'm not going to talk about the fourth point, but they also have an important role to play in making sure that the payment system as a whole is safe, so that when debits and credit cards or loans are made and deposits are taken, that these are reliable, and that the right sorts of people are running banks. And this is part of the sort of consumer protection activities. Now, none of this sounds anything like climate change. Now, why is climate change being brought in? Often, as well as these kind of primary roles, central banks also have secondary roles, which is really to often help the overall ambitions and work of the government to whom which they sometimes report and sometimes they're independent from. So in many countries, central banks' secondary role is to develop sustainable financial systems, to promote full employment, promote currency stability. So there's a whole bunch of secondary roles which many central banks have, and especially in some of the African and Asian countries, these secondary roles are actually quite important because they're often very, very powerful institutions in their own rights. So I'm going to say a word or two now about how they go about with these objectives of theirs. On monetary policy, some of the kind of actions that they might take are what we call open market operations. And this is where central banks actually go into the marketplace, the debt capital market or the currency markets, and buy and sell currencies, assets, that kind of thing. The second thing that they do is that they provide retail banks, the banks that you and I use, with liquidity. And this is something called the collateral framework, which I'll come back to in a moment. But really, they basically provide other banks, other financial institutions with money that they can then lend on to people like you and me. As I mentioned earlier, they also maintain minimum reserves. So every time you put a deposit in a bank, the bank has to then put a deposit in the central bank to make sure that it's got enough money to pay you back should the need arise. In many OECD countries, including Japan, US, and Europe, ever since 2007 and 8, because interest rates have already come down to zero or near zero, they've done new non-standard monetary policy, what we call QE, quantitative easing, where they are allowed to go out into the marketplace and buy very substantial sums of money in terms of other types of assets. And we've just been reading that lately the European Central Bank is out there buying 750 billion euros worth of quantitative easing in order to shore up accelerate economic activity after COVID. Prudential regulation, this covers quite a wide range of things, but at the moment the banking sector is covered by the Basel III agreement, and there's similar kind of agreements in insurance industry called solvency here in Europe. And this is making sure that when a bank is in operation, it has enough eligible capital. So every time it lends money, it has to prove to the central bank that yes, we've got certain amounts of mortgages, certain amounts of loans, and therefore, should the need arise, we can pay back everything we've lent out. There's things like leverage ratios, which means that they have to make sure that they're not borrowing too much, and that there's a certain amount of equity, that there's shareholder capital at stake, and this liquidity can be short-term and long-term. This all sounds very complicated, but it's basically to make sure that if depositors want their money back, there's enough money in the bank to get the money back out again. Now, why is this important? Because this is really a mechanism by which central banks can actually control how much is being lent and to whom it's being lent. And the others, I've just put in various things that central banks could do or do. Some central banks are responsible for making sure that the currency is not overvalued or undervalued, so they try to maintain it within a certain level. And this is quite common in many emerging markets where the central bank has a role in going out there and buying foreign currency denominated assets to make sure the currency stays within a band. And some central banks also are directly purchasers of or investment managers themselves. They maintain pensions for their own staff, for civil servants. And in the case of Norway, Norwegian investment management by the central bank is one of the biggest owners of assets anywhere in the world. Credit guidance, this is a term that's not really used in the West, but in developing countries, emerging markets, etc., central banks actually tell local banks, you must lend so much to fill in the dots. In Bangladesh, there are particular targets for export-oriented industries. In India, the central bank, the Reserve Bank of India, insists that at least 20% of all lending has to be to agriculture, because agriculture is something that is important to the economy and has traditionally been underserved. Okay, now, why are we talking about all this, and why do central banks come in? Now, this is really the reason why central banks have been enlisted to work on the fight for climate change, fight against climate change, is because climate change poses a terrific risk to financial stability. If you think about it, if banks are lending to companies involved with, say, funding oil and gas reserves, and there's a sudden increase in carbon pricing around the world, then suddenly all these assets, all this kind of output from these sectors will suddenly become devalued. And this is called climate mitigation risk. So this kind of issue has the capacity to have massive downward effects on the survivability of banks. A country like Indonesia, for instance, a very, very substantial economy, a huge proportion of its economic activity and its foreign exchange is earned through coal exports. So if the markets for coal suddenly dry up, and this poses a massive risk to the financial stability of the banking system. So these are transmission via of the mitigation risks. A second type of risk from climate change is that assets that we thought were secure, which were reliable, like mortgages that underpin the housing market, if after a massive climate event, they suddenly become damaged and destroyed and valueless, then suddenly this is a risk against the financial stability of the country, because these assets which are underpinning the bank's ownership of what it can lend on are suddenly reduced in value. So this is a separate second type of transmission through physical effects. A third issue might be that some of the kind of litigation against oil and gas companies, against fossil fuel companies, might suddenly make these kind of firms non-viable. And this is known as litigation risk. So these are the type of activities that could give rise to instability, financial instability. And what I've done with this graphic is very quickly try to explain how these are transmitted from a particular transaction, let's say bank lending to something, to a financial system as a whole. So if you look at this graphic from the left to right, a bank might do something like lend money for a particular project, or purchase an asset like some bonds or a loan book to do with fossil fuel lending, or an insurance company might make an underwriting decision to insure a house which is at risk from flood. Then suddenly, if there's some kind of environmental event, then this is then manifest through the individual assets up to the company level. So suddenly the company is the bank that's the company that owns these assets can become vulnerable to its price in the market suddenly collapsing. And this is this kind of risk of stranded assets put at the bottom here. This is then transmitted to the financial institution. So if, for instance, the bank or the insurance company is lending to these fossil fuel based organizations, or if it's lending to homes which are in a flood risk area, then this financial institution is suddenly weakened as well. And this kind of affects in terms of the share value of the bank. It can have effects on the viability of the insurance company. And this is, at the bottom, I've written this down as an impairment of the balance sheet of the bank. And finally, if enough of this happens, then the financial system itself may come under stress. And this is a kind of liquidity crunch where banks are suspicious of the assets that other banks are owning and are refusing to accept and lend to other financial institutions. This is the kind of thing that happened back in 2008, where banks lost confidence in one another, and then the whole financial system was gummed up and glued up. So this is the kind of transmission mechanism that is, in a paper that we wrote, we kind of proposed might manifest to the banking system and to insurers. And that's why central banks are sort of taking an interest in this kind of issue. So I'm conscious of time now, and I don't want to eat into people's time too much. We've written a paper called Tilting the Playing Field, where we're saying that central banks, rather than just waiting for these kind of disasters to occur, they should actually proactively go in and try to influence the way that banks and insurance companies operate. And the purposes of these kind of interventions are twofold. One is to make sure that the financial system itself isn't vulnerable to climate mitigation, climate risks, which is an important endpoint in itself. But a second issue is that to make sure that the banks and insurance companies are doing their bit to make sure that there is investment, adequate investment into the green economy and away from the brown economy. So there's a twofold task here: to protect the financial system from climate risk, but it's also to protect the climate from financial systems as well. These four rows are the different type of actions that central banks and supervisors may take. The first one I've sort of labeled regulating transparency. And by that, I mean that this is where central banks ask organizations that they're regulating, the banks and insurance companies, to reveal to stakeholders exactly how much risks they're sitting on. And we suggest four different kind of objectives or tasks that central banks might do. Firstly, they might define what do we mean by a green or a brown asset. So a green asset might be things like renewable energy. A brown asset might be a coal reserve. And so just set definitions. And for some, it's actually quite difficult to do this. Is an iron ore mine a green or a brown asset? When does a green asset become a brown asset? What are the thresholds? Second aspect of transparency is to make sure that financial institutions publish and disclose these kind of how much assets that they're holding like this. The third thing is, rather than just looking at the present situation or the past situation, let's look in the future what might happen. And some central banks now are starting to ask regulated entities to do scenario analysis, where they're actually mapping out what would happen to your balance sheet if carbon price went up. And then the fourth thing is to actually do a stress test, where they ask for a number of different variables to be changed at the same time, and just see if the bank or the insurance company is actually viable under these kind of stress tests. The second row is the kind of things that central bank could do as a purchaser of assets. So it can do non-conventional monetary policy. At the moment, this 700 billion euros that the ECB is purchasing, can it instead purchase less brown bond issuances? Can it buy more green issuances? And not monetary policy is obviously the big one, but not all central banks will do unconventional monetary policy. This is something which really largely only OECD countries do. So staff pension schemes that central banks run, that might be another option, and currency stabilization funds a third way that central banks don't buy things themselves. At the moment, central banks tend to be very market neutral in the sense that they will buy any asset that fulfills certain criteria in terms of liquidity and credit rating. But what, instead of using these criteria, they use different criteria and say, actually, we don't want to buy any assets that are to do with fossil fuel. We're going to sort of discriminate slightly against them, tilting against them. The third row here is to do with the way that the collateral framework and the capital adequacy frameworks work. But these are applied under the Basel, the capital adequacy is part of the Basel III regulatory system. This is saying to make sure that banks are properly capitalized, they have to show this is the type of assets that we're holding and owning. Well, again, these can be tilted according to this brown and green taxonomy. The collateral framework is a similar kind of mechanism where banks borrow overnight or for a short period of time from a central bank. So again, the collateral framework can be tweaked to make sure that only certain type of assets are accepted and others aren't. And interestingly, Christine Lagarde, in a speech over the weekend, she's said she's interested in exploring this, exactly these options with the ECB, which is quite a departure from policy so far. And the last thing, which is something which I think is particularly important in many emerging markets where central banks have traditionally been more interventionist, they can actually say, well, we want to set banks quotas. So we want you to go out and lend to sustainable agriculture. We want you to go and lend to renewable energy. And this is certainly found in some Asian economies. I've mentioned already that Bangladesh and India do this. A third option, another way of doing this kind of credit guidance is for central banks to say, well, we would like you to lend at a slightly lower interest rate to these preferred greener activities and maybe increase the interest rate for the brown activities. And interestingly, one central bank in Europe, the Hungarian central bank, is doing exactly this, saying that we would like a small discount, maybe about 0.3%, a small discount to be offered to green mortgages. And we will we will subsidize those activities. So these are the kind of activities that central banks could take if they were so minded. In our report, and you can see it on the final page of my PowerPoint slide, we make a number of recommendations about what central banks could and should do in the short term and long term. In a way, this is just restating some of the points I've just made. So we think it's very, very important that central banks or governments define a brown taxonomy and explain how it should be used. There's no good saying that we need people to invest in brown, away from brown and more into green without telling them exactly this is what we mean. This can be done quite quickly. So we think this is a short-term activity, and it's something that my organisation is very keen to help others to do. Decisions, useful transparency. It's no good just being transparent and just asking banks to publish the amount of recycling of paper that is taking place. They have to provide information that's actually helping investors and other stakeholders understand what kind of risks they're facing. So this is mandating financial institutions to disclose what their risks are. And this is really part of the TCFD agenda, which is kind of already happening to an extent, but we'd like to see it happen more quickly. Climate scenarios and stress tests. This is something we recommended back in July. It's already happening again. So we're really delighted that some of these ideas are already coming to fruition. What's not happened so far is some of the prudential regulation. This is where we're trying to change risk weightings and and haircuts for assets. So this is something we think in the medium term should be done. Monetary policy, this is where collateral frameworks are being tweaked so that there's a strong incentive to invest in green and an incentive to withdraw money from some of the more climate risky lending that's taking place. And the last two I've put down here are really for when they're buying assets for currency reserves or pension funds. Again, it can be done quite quickly in the short term. A number of central banks are already doing this, where they're actually applying green screening and brown screening to sort of say that we don't want to invest in coal-fired power stations or certain type of asset that is giving rise to more climate risks. I'll stop now because I'm conscious of people want to ask questions, but if you're interested in about this, we published a report, Greening the Financial System, Tilting the Playing Field of All Central Banks, which was published last October, and it's got all these recommendations and lots of case studies that you'll find very useful. I've also put a couple of other slides at the very top, references at the top, and this NGFS stands for the Network for Greening the Financial Systems. And this is a network now of 66 central banks and supervisors. I think there's about 12 observers, and I think 2 African banks are currently part of this. It's the Tunisian Central Bank and the Moroccan Central Bank. I'm not aware that any sub-Saharan central banks are yet members, but I know they're very keen for other people to become involved. This is a fantastic network which is sharing experiences of what central banks, the best practice, and I very much recommend having a look at their website. It's currently curated by the Banque de France. They provide the secretariat with the NGFS. We're working very closely with them. Thank you ever so much for the opportunity to speak, and I'm happy to take questions.
Thank you very much, Prashant, for a very insightful presentation. Just for listeners or viewers who are just joining us, we've just had an interesting and very insightful presentation from Prashant. He is head of government, head of policy and government at the Climate Bonds Initiative. He is also the country head of India for the Climate Bonds Initiative. He just spoke to us about the role of central banks in helping to manage climate risks. Joining him on today's panel is Peter Windsor and Pier Paolo Grippa. They are both financial market experts from the International Monetary Fund. They will be speaking to us later. We've got some questions for you, Prashant, so I'm going to shoot and ask you those questions. Prashant is going to leave. He's got a prior engagement, so we're just going to spend another about 5-7 minutes with a Q&A session for him. The first question I've got, and I've received it from 2 different sources, so he's really serious about this. He wants to know, what are African central banks doing to manage climate risks?
Well, I think, as I mentioned, the ones I'm most aware of, and we do still maintain a database with covering the various policies. It's so far as the Tunisian Central Bank, which has only just started joined NGFS. So that's the bank, the Tunis, I think. I think the more active one is actually the Moroccan Central Bank, which has been active really for a number of years. So I think what they did was they got together with some of the other prudential regulators and financial regulators within Morocco and jointly developed a financial, I think they called it an action plan for how to advance the green economy there. But I have to say, most of the sub-Saharan Africans are not so advanced at this moment in time, but we're more than happy to help. And we're doing a fair bit of work at the moment with some of the ASEAN countries. So this is something we think is a massive opportunity.
Okay. The next question is, in terms of central banks thinking about managing climate risk or as using as part of their regulatory frameworks, which central banks can you highlight as best practice that people should look at?
Well, so some of the best ones in terms of the stress testing, I think the Dutch central bank did a number of in-house bit of work, and then they also involved some of the supervised entities. So they've done some excellent work. So that's DNB, they call it, which is the Dutch central bank. The UK's own Prudential Regulatory Authority has done a couple of studies, and they've currently, they're about to do some stress tests for the next 2 years. And these are on their websites. So if anybody's interested, they can take a look at the documents. So they've actually set out exactly the scenarios that they would like supervised entities to run. There's currently a consultation that the ECB is running as well. So that this is really for all the systemically important banks in Europe that are managed or supervised by the ECB and its kind of network of regulators. So those are the three I would probably draw attention to now. Banque de France has actually done some interesting stuff as well.
Okay. The next question is, if central banks join your green network, are the rules binding, or they just merely you apply them on the basis of best efforts?
Yeah, I should stress it's not my network. I mean, it's very much it's the central bank's network, Banque de France and Secretariat. It's a coalition of the willing. That's the way they phrase it. They share experiences. It's not like the Basel Committee or anything like this. It's people who want to understand and learn more. Nothing is binding. So they run surveys. They undertake training and these kind of activities.
Okay. Last question for you. I'm mindful of your time. What do you envisage under Basel IV regarding climate risks? Do you have any sort of insights?
I'm afraid I'd be guessing. I know that the Frank Elderson is part of the committee, and he's also the chair of the NGFS. So the extent to which he can influence the Basel and the BIS and everything, there might be something from that, but it's slightly beyond my pay grade, sorry.
Yeah. Then the last thing is, beyond stress testing, what tools do you think central banks can use to force financial institutions to shift their investments towards more greener investments?
I personally am very attracted by some of the credit guidance policies that are operated in some countries. So if the country has a sort of a tradition of central banks intervening and trying to steer lending in a particular direction, I think that's a really, really effective tool. You can either do this through actual targets for saying that each bank needs to lend so much, maybe have them tradable. So the banks with a big rural presence or a big presence in renewable energy can overachieve on their obligation and let sell to somebody else. So that's one mechanism. And this idea of discounted interest rates is quite attractive too, I think.
Okay, last one, then I'll let you go. Somebody just asked posted a question I thought was quite interesting. Aren't you falling into the risk of central banks being everything to everyone, saving us, aren't you asking central banks to do too much? Isn't managing the economy or preserving price stability a big enough task?
I think central banks have to focus on the really important stuff. That's what they're there for. And I think climate risk is one of those really important things. Is it too much? Well, they're not going to be working in isolation. So they need to work, with each other, so through the NGFS. And I think, unfortunately, finance is an international issue. So unlike, it's important that the financial system and the way it's regulated does link up. A bank in Africa might be lending to projects or in other countries. So I think it's really important that central banks, probably more than other organizations like finance ministries, do need to think across the board to the effects of their lending behaviors on climate. So I think they have to do this.
Okay. Thank you very much, Prashant. I'm conscious of your time. We will, if we are getting some additional questions, but what I will do is we'll put them together and maybe drop you an email, and then we can send it directly to the participants. Once again, thank you very much for a very insightful discussion.
Thank you, Kwame, and I'm more than happy to stick around another 5 or 6 minutes. Thank you.
And good luck with your engagement.
Cheers.
Right. With Prashant gone, we have two experts from the International Monetary Fund, popularly known as the IMF. They're senior economists, both in the monetary and capital markets. They are also going to be talking to us about climate change and the risk to the financial sector. Gentlemen, I open the floor.
Thank you, Kwame. I'm Pierpaolo Grippa. Thank you again for the invitation to this conference. And let me switch to the presentation. Just a minute, patience. Okay, I hope you can see the presentation. So this is about the role of central banks and financial regulators in managing climate risk. We already have heard from the previous speaker something about this. And we will go through a number of topics. First of all, before we speak of the role of central banks and financial regulators, it's important to understand what is the role of the financial sector for climate change. There are risks, but we will see there are also opportunities. And let me just spend also a couple of words about a topic that has been discussed quite extensively recently, which is the green recovery. Then we will move to analyze the role of central banks that has been just discussed by the previous speaker. It's interesting that we have views that are partly converging and probably in some aspects different. And then also we'll see what is the role of financial regulators, which is not necessarily the same. First of all, not all central banks are financial regulators, and even when they are, they generally have different mandates, and this is quite important. And my colleague Peter Windsor will touch on climate-related disclosures and recently published guide for supervisors. Finally, I will briefly touch on what is the role of the International Monetary Fund in all this. So what can the fund do in terms of analysis, policies, and surveillance? So let's start with the first topic. Just, sorry, can I get a feedback? Can you see and hear? Kwame?
I can see and I can hear clearly.
Perfect. Thank you very much. Thank you.
All right.
So let's first see what is the role of the financial sectors in climate change. And let me start with a quote that I like particularly. Last year during the spring meetings at the IMF, there was a very interesting one-to-one discussion between Sir David Attenborough, the famous British natural historian, and Madame Christine Lagarde, at the time the managing director of the IMF. And this is an extract from a piece that they published on the Financial and Development, which is a magazine published by the fund, and is as a whole issue devoted to the economics of climate. What I like here is the parallel between the financial world and the natural world. And the idea that we sometimes, and quite often, unfortunately, do to the natural world what we would never do with financial capital. We would never deplete financial capital down to the point of financial ruin. But sometimes we just do not consider that the natural world is also a finite amount of stock like a capital. So the conclusion is we must treat the natural world as we would the economic world, protecting the natural capital so that it can continue to provide benefits well into the future. And in this, of course, the financial sector has a role to play. Has a role to play in analyzing, first of all, what are the risks, and we will follow the now usual taxonomy of physical and transition risks, and we will explain what are the different aspects of these risks, but there are also opportunities. Starting, however, with risk, we first of all look at physical risks that my colleague Peter will define more clearly, but just to give you a sense of how relevant this can be. These are basically the risk of the direct impact or indirect impact of climate change. And there is this, there is a University of Notre Dame in the US that has created these indicators of vulnerability and readiness of countries to climate change. the things here I plotted the values for Africa, for African countries that are in the database. So this is an index that summarizes a country's vulnerability to climate change and other global challenges in combination with its readiness to improve resilience. The vulnerability is based on the exposure, sensitivity, and adaptive capacity, and the readiness is based on economic governance and social readiness. What you can see is that there are a number of countries that have a quite high value both for vulnerability and the complement 200 of readiness, which I call the unpreparedness. So what it shows is that there are countries that are both vulnerable to climate change, but also not necessarily as prepared as one would wish them to be. And this is, and also I think that what this graph shows, and this is certainly something observed for Africa, but it's the same for also other areas of the world. Unfortunately, there is a bit of a positive correlation between vulnerability and unpreparedness. So not only certain countries can be more exposed to the risk, but sometimes this comes also with less preparedness. Let me leave the floor to my colleague Peter, who will tell me when I need to switch the slides.
Thank you, Pier Paolo. So as Pier Paolo indicated, I will try to define physical risks for you. So physical risks are due to losses arising from damage to property, infrastructure and land. Physical risks can be broken into two categories: acute physical risks due to the impact of climate and weather-related events. So this includes the destruction of assets due to events like floods and windstorms, and chronic physical risks due to progressive shifts in climate and weather patterns. For instance, this will be something like houses becoming uninhabitable without modification due to frequent flooding. Typically, lower and middle income countries are more exposed to physical risks, and as the previous slide showed, this is an issue for most African nations. In the IMF's Regional Economic Outlook for Sub-Saharan Africa, Chapter 2, published last week, it was stated that Sub-Saharan Africa is the most vulnerable region in the world to climate change. I commend this publication to you to understand more about the impacts of climate change on Sub-Saharan Africa and some policy recommendations to address those issues. I won't cover it in more detail today, as it does not go into depth regarding today's topics. I focus on the insurance sector, and I will talk about that today as we were asked by the organisers to address insurance and reinsurance issues. So the first point I would like to make is a rather obvious one. As physical risks increase, insurance is likely to get more expensive or become unavailable for assets exposed to significant climate risk. All things being equal, this increases the costs of maintaining productive assets in those areas, and therefore will have an effect on decreasing the value of those assets. That is a matter of concern to other financial sectors, not just the insurance sector. These increasing insurance premiums will provide a clear signal, though, that investment in mitigation and resilience will have economic benefits through reduced insurance premiums. Next slide, please. Financial institutions are exposed to physical risks through their exposures to corporations, through investment and lending, households through provision of credit, and countries, sovereign risk, where climate shocks are experienced. The climate shocks will lead to destruction of assets and therefore the value of investments, credit losses, borrowers unable to repay the full value of loans due to losses they have sustained, and business disruption while recovery occurs. Insurers and reinsurers in the property and casualty sector are particularly exposed to physical risk. They have it on the asset side of their balance sheet through investments and lending, and on the liability side of the balance sheet through higher frequency and severity of claims. They are also exposed to transition risk, which Pier Paolo will cover. One thing we can expect to occur is correlation of previously uncorrelated events. I give you a possible example. You could get one side of a continent exposed to more cyclones, typhoons or hurricanes due to climate change, while another part of the continent experiences more wildfires. You wouldn't previously have seen a correlation between those events, but now there is a common factor increasing the incidence and severity of both. This correlation translates to higher risk, particularly for insurers and reinsurers that price risk on the basis of being able to diversify uncorrelated risks. Insurers and financial markets can be part of a solution to providing resilience to communities facing physical risks. Insurers and financial markets through alternative risk transfer products like catastrophe bonds can provide support to communities and financial sectors that are impacted by physical risk. Insured assets provide more secure collateral for lenders such as banks and counterparties that insure their physical assets, and their operations will be more stable credit risks. A well-regulated, viable insurance sector will therefore be important for a country to be able to deal with these emerging risks from climate change. I now turn to next slide, and the IMF's Global Financial Stability Report of April 2020, and Chapter 5, which was published recently, which addressed the issue of physical risks. It showed that there are two main channels through which physical climate risk can impact financial stability. The first channel, current climate disasters. This is where a climatic hazard turning to a disaster which affects households, non-financial firms and the government sector, creating economic disruptions. The financial sector firms exposed to shocks through underwriting activity, the insurers, lending activity, mostly banks, and the portfolio holdings of affected securities. There also can be operational risks to those financial institutions and liquidity risk arising from these events. The second channel is about investors' beliefs about physical risk in the future. Investors should demand a premium for holding assets exposed to physical risk. This depends on complex interactions, and markets may not price future physical risk correctly. If there is a sudden shift in investors' perception of future risk, this could lead to a sudden drop in asset values. A key finding of Chapter 5 of the GFSR is that evidence indicates aggregate equity valuations do not appear to reflect predicted changes in physical risk under various climate change scenarios. That's as at the end of 2019 data. So I've given you a link there to learn more about that publication. Next slide. So now I'd like to talk to you about a insurance-specific issue called the protection gap. This is the difference between economic losses and insured losses. Increasing economic losses are a result of increased number of and severity of climate-related disasters, and also the build-up of assets in areas exposed to physical risk. This protection gap has widened over time. If we can just go to the next slide briefly, which actually shows the increasing protection gap over time through the 1980s, the 1990s, and through to the just finished decade, the end of 2019. So going back to slide 10, Lloyd's of London has actually come out with an estimate that a 1% increase in insurance penetration is percentage of GDP spent on insurance premiums, can lead to a 13% reduction in uninsured losses and a 20% lower disaster recovery burden on taxpayers. Again, going to Chapter 5 of the GFSR, it found there is a statistically significant association between greater insurance penetration and higher returns in the immediate aftermath of a disaster. 1 percentage point increase in non-life insurance penetration improves banking and industrial sector returns by 1.5 percentage points in the immediate aftermath of a disaster. So reducing the protection gap can actually lead to increased investment and higher output.
Okay, and moving to transition risks, let me define them as Peter did for physical risks. So a definition, there are many available, but the definition I'm using is losses. So the risks are related to losses resulting from changes in climate policy, technology, and consumer and market sentiment during the adjustment to a lower carbon economy. So first of all, we need to assume that this adjustment to lower carbon economy actually happens. And of course, it is becoming increasingly clear that this transition is needed. And it is so clear that now even the agents, the actors that were more reluctant to recognize this are increasingly recognizing that they need to reduce their emissions and for example, in the case of oil majors, there have been many announcements quite recently about very targets and objectives that are quite ambitious with respect to what we use the case. So once we recognize that there is there will be and there is an ongoing transition to low carbon economy, it is important to understand what is the role that climate policy, technology, consumer market sentiment have in this transition. So let me give an example for all these and how this can translate in a shock. Climate policy, the main example is the introduction of a carbon tax that might make fossil fuels produced, especially those produced at a very high cost, completely uneconomical, and put them out of market and cause that phenomenon that has been already defined as stranded assets. Technology, we have seen very clearly in the past decade how technological progress can be disruptive, for example, with incredible reduction in cost of renewable energies that have become more convenient than fossil fuel, building new fossil fuel plants, but sometimes even running existing fossil fuel plants around the world. Then there is consumer and market sentiment. I mean, consumer sentiment is also shifting. We know of all the Fridays for climate change. There were staged in the past year by students around the world. We know that the new generations are more sensitive to these issues. In Sweden, they coined a term called translates more or less like flight shame, which is basically the shame that citizens, especially of advanced economies, should have in flying too much, considering that a single intercontinental flight can have a carbon footprint higher than the overall year carbon footprint of a citizen in many low income countries. So there is certainly a shift, and there is also a market sentiment shift, because we are seeing increasingly that there is a lot of attention about so-called ESG, environment, social governance linked financial assets. There is increased activism at shareholders meetings to have companies, especially companies that are seen as more polluting, change their business model. And these different source of shock can interact with each other. So of course, the climate policy might help a technology to spread faster. And if consumer change their attitudes, say for example, embracing more electric vehicles than internal combustion ones, then this also can accelerate the change, and so on. Now, once we have set what are the shocks, how these propagate to the financial markets, because in the end, what we're interested here is to understand what are the risks for the financial markets and institutions. And I find this this graph by the 2 Degrees Investing Initiative quite interesting. This is a global think tank for developing climate, long-term risk metrics, and related policy options in financial markets. And here you see there are basically 2 channels. One is a channel where change here in policy or technology can lead to an impact on the company's value chains, on their own operations, on the supply chain. So, for example, for industries or sectors with low or no mitigating policy, for example, no carbon taxes or no, and especially if they have high greenhouse gas emissions, these can be particularly exposed in case there is an important shift in policy or technology, and their earnings might be affected, the revenues might be affected. On the other hand, of course, there are also more green-oriented companies that can see their revenues increase instead. So this can lead to an important shift in the fortunes of different companies. This can have an impact on the balance sheets of these companies, which in turn might be receive lending from banks, or might have bonds that are in the portfolios of investors, and so this eventually has an impact on financial markets. But there is also a more direct impact. More macro impact, which is basically when you think that policy and technology can lead to change in macro variables. For example, a carbon tax could increase the cost of energy and have an impact on inflation, or it can, if the revenues from the carbon tax are used, they can increase the footprint of the government in the economy. And there are a number of changes then, and if this happens abruptly, so without not in a sufficient gradual manner, then this can have an impact again on the financial markets. It's the link between the impact on the microenvironment, the impact on financial markets, is a bit the traditional one you can see, for example, in stress testing, where you see, okay, given a shock and in the microenvironment, what happens to the banks, insurers, and so on. But what is a bit different is what determines instead the link between policy and the impact on impact on microenvironment. So this link is circled with a green circle, and similarly also modeling the impact of policy, technology, consumer market sentiment on the impact on companies is far from trivial. As a similar chart to the one we show for physical risk, except that here there is no ready-made index. So I built one where you have on the x-axis you have the share of fossil fuels on GDP. Why this? Because this is an important channel for those countries that are fossil fuel producers. So here is where the microenvironment can be a big transmitter of shocks. Imagine an oil producers, and we have seen in the recent times what happens when the price of oil collapses. So it endangers the public budget, and then it can have an impact on output and employment and so on. And so, of course, this then can translate into impacts into the financial system as well. So on the x-axis, you have fossil fuels as a percentage of GDP. On the y-axis, you have a different indicator that is more linked to the first channel I showed, which is a carbon pricing gap. So basically, the idea here is to measure how far a country is between a certain benchmark carbon tax, which here I chose to be $75 per ton of CO2, which is the midpoint in the range indicated by the IMF as consistent with the 2 degrees goal. So basically here what you have is that you consider the CO2 equivalent emissions of a country, and you multiply this by the current gap in the carbon price, considering that except for South Africa, no African country, as far as I know, has a carbon tax in place. This means that for most countries, this would imply multiplying their emissions at country level for the benchmark, which is 75 per dollar, and then comparing this to the GDP of the country, just to get a sense of how big this, how material this transition might be for each country. And here again, you see that there are countries that are exposed in both from the point of view of the macro impact as fossil fuel producers, but also from the point of view of having no or very low carbon pricing in place at the moment. I put also for comparison to the values of these two indicators for advanced economies, non-fuel exporters between emerging market and developing economies, and fuel exporters. Of course, as production, fossil fuel production is an indicator of how big a problem, transition risk can be for a country. So is the share of export. So here we see that fuels represent more than 95% of Angola's export. They are also an important share of export in Ghana, but a bit less so. So of course, you have different situations for different countries depending on their reliance on fossil fuels. I mean, this is something that predates the whole debate about climate change. The fund has always advocated diversification, so trying to use the proceeds of fossil fuels to diversify the economy. Of course, this is not an easy task, but it remains important. It becomes even more important, of course, with the transitions that is happening for climate change. Let me move to the to an example of how transition risk can materialize. So financial institutions can incur losses on exposures to firms that have business models not aligned with the transition to a low carbon economy. The typical example is of fossil fuel companies with reserves that could become literally unburnable, as previous governor of the Bank of England, Mark Carney, said, in a world that is transitioning to a low carbon global economy. In the chart below, that is taken from GFSR of October last year, you can see you should follow the blue line. The blue line is the Dow Jones Coal Index, and it went inexorably down and down and down through the decade. Actually went further down. I took the quote of yesterday. It's 9.27 against the peak that was March 2011 of 481. So a drop of 98%. Of course, if you think of an investor that has a portfolio heavily tilted towards this sector, you can imagine what is the devastating losses that that portfolio could have experienced. What is interesting here is that coal is not, the fate of coal has not been dictated by policies. On the contrary, if you think in the past years, the current US administration has also tried to do whatever they could to help the coal sector, but here there are very strong technological aspects. In particular, for the US, has been the boom of the shale oil and gas that made abundant abundant and cheap gas available, and has led many power plants that are the main consumers of coal to shift from coal to gas. So this shows how technology can be a big driver of change. Here there is another study by the Carbon Tracker Initiative, which is a think tank based in London, that has estimated the share of unburnable reserves. So here the idea is that at the current consumption rate, the proven reserves of different fossil fuels would allow a certain amount of years of production. And as you see, it goes from 50 for oil to 132 years for coal. But if you see what is the amount of these fossil fuels can be burnt without exceeding the limits of a carbon budget, like for say 1.5 or 1.75 degrees with a 50% chance, then you see that this is the chart on the right. You see that it's impossible to use all the to use all the proven reserves. Actually, just a fraction of the existing reserves can be burned without compromising compromising the climate even further. The Carbon Tracker Initiative also has made calculations for the necessary drop in oil majors production. This is if you look at the fourth column from the left, you see that the annual decline in the production that these major oil companies should experience in order to not to produce too much oil with respect to a target of 1.6 degrees Celsius. You see that not only these oil majors should not be able to grow, actually they should shrink annually at rates between 0.5% and 3.8%. So this is just to give a sense of the size of the problem. Now, of course, one can, this doesn't mean that these companies are necessarily doomed, in the sense that they could reorient their investments, and some majors are trying to do this, trying to shift from brown to more green investments. And of course, this is a welcome shift. Unfortunately, in most cases, this is happening at too slow a pace to really make a difference. And it's too slow not only for the purpose of climate change action, but also from a financial point of view. If you think of the performance of the U.S. coal sector in the last decade as a cautionary tale about the risk of inaction or too slow action. Similarly, when we analyze the impact on the economy at large, there are we must always consider that yes, there are risks, there are losses, but there are also favorably secondary effects that should be taken into account. For example, if there is a carbon tax is introduced, of course, this could increase the cost of energy in the country and have a dent on output or possibly also on unemployment, but this can be compensated and countered by the use that the government makes of the revenues from the carbon tax. So it's always important to remember that there is a complex system where we need to consider all the different effects. Now, because of these and other complexities, for example, another one is how change in prices led by policy action or technology interact with the autonomous volatility of fossil fuel prices. As I was mentioning before, that the oil price has collapsed in March and April, and of course this is not related to climate action. Was due to a completely different reason. Was a consequence of the lockdowns to fight the coronavirus pandemics. But of course, it's important to understand that there are many factors at play. This all makes the modeling of transition risks a very challenging task, and that explains also the significant dispersion that is observed in the currently available estimates of the impact of transition risk on the economy. Let me just focus on the first line here. This is taken from the NGFS, the Network for Green Financial System report. They have the range of estimates for transition impacts on the macroeconomy. You see that in the first line, the Intergovernmental Panel for Climate Change made a summary of 31 models and more than 1,000 scenarios, and found that on average there is an impact between 1 and 4% of global aggregate consumption levels. But there is a lot of uncertainty around these figures. You can see that the other lines they come with different results. The reality is that this is extremely difficult to measure, and also these results at aggregate level might hide what is a very important aspect, that is the distributional effects of these changes. So it's not just a matter of GDP dropping or increasing a certain amount, but who is going to be affected by this possible drop? Whether there are big losers against some that maybe can even be winners. And this is, of course, very, very difficult to estimate. Now, let me quickly, I'm mindful of time, let me go quickly to the opportunities. So there are risks, but as I say, there are also business opportunities. a low carbon transition could require between 2.3 and 3.5 trillion in energy sector investments every year for decades. This is according to estimates by the IMF and the International Energy Agency. Now, a large part of this will probably come from public funds, but there are still huge opportunities for the private sector to contribute. In order to appropriately channel funds where they're needed and avoid resource misallocation and especially greenwashing, so the practice of claiming that some investments are green when they're not, information and data must improve. So what is needed is more accurate, widespread, and comparable climate-related disclosure, and Peter will discuss this in length. Green-brown classifications, and I will return on this, and also systematic data collections based on standard reporting. Here, okay, I will go very quickly through this just to say that the green bonds, the green bonds market has grown. This is a chart taken again from the GFSR of October 2020. The green bonds, for example, has been growing steadily, and it's the largest component of the ESG debt markets, but it's still a very tiny fraction of global bond issuance, around a few percentage points. So there is still, it's important to keep this in mind, especially, for example, when there are talks like we heard that the central banks should invest more on green bonds. The point is that there is also limited supply of these bonds, or also of other assets like equity, fund, and ETF. They're also growing, but they're still very small at the moment. Speaking of opportunities and the risk-return frontier, what our colleagues at the IMF found is that historically there is no systematic evidence that sustainable funds regularly over or underperform. Again, this is from GFSR October 2019. More recent evidence coming from the COVID crisis, is that there seems to be a higher resilience of sustainable investments in a period of turmoil like the current one. You see the sort of yellow line at the top is for an index of ESG assets, and there is some evidence indeed that these kind of assets are liked by the investors also because they seem to be more resilient. So I briefly mentioned green-brown classifications, but we've been using this term green-brown loosely. But exactly what is green and what is brown? Without a clear definition, there is huge room for abuse. I was mentioning greenwashing before. The problem is that if this happens, then there is a loss of confidence in the green labeling, and this can eventually cripple the green finance development. So it's important to have classifications, and it's important that classifications are not binary. So as Mark Carney said, we need 50 shades of green. We need a common taxonomy to help financial markets identify environmental outperformance and direct investment accordingly. That's what Mark Carney says. I bring an example that of the European Union taxonomy, which is a classification tool to help investors and companies identify environmentally friendly economic activities. And the criteria they use are, first of all, to distinguish between assets that are already low carbon. For example, imagine renewable energy like solar panels. Enabling emission reduction. So for example, imagine a manufacturer of wind turbines that is not in itself particularly green, but is producing something that will help make the economy greener. All contributing to a transition to a net zero emission economy in 2050, like for example, building renovation. But what is important in the EU taxonomy is that there is also do no significant harm to other environmental goals. So the idea is that to not look narrowly at how a certain activity can improve the fight against climate change, but also to look at other environmental goals, for example, pollution prevention. And at the same time, complying with minimum social safeguards, for example, workers' right to organize. There are other taxonomies available, for example, in China, Bangladesh, Vietnam, Pakistan. There are private sector initiatives on national and international level, and also internally developed classifications at some financial institutions. Now, what is quite clear is that there is not harmonization yet. There is not a common taxonomy, and this is something that the financial sector still needs to work on, because without a common taxonomy, it's impossible to make comparison between different assets. Fine, let me end this part with something that, as I said, has been discussed quite extensively, and our managing director, Madame Kristalina Georgieva, is now speaking, I think at this moment, at a US Chamber of Commerce at an event on the called From Great Lockdown to Great Transformation. She started as an environmental economist at the beginning of her career, so she feels this topic quite strongly. It's clear that the initial reaction of all governments and central banks around the world has been focused on the immediate issues of the created by the COVID, which is basically ensure that health supply of health products and services is ensured, supply of basic needs is ensured, and then immediately to create bridge financing or subsidies and grants for help people that cannot work during the lockdown, to help also businesses that must shut during the lockdown. But it's also clear that now big investments are needed to rekindle the economy. And so the question is, how should this happen? And what our managing director says is that if this recovery is to be sustainable, we must do everything in our power to promote a green recovery. And I like the idea that this is not just something that is nice to have, it is a must-have, something that we really need to work on. We need to bridge a more resilient future. How can we do that? Well, there are a number of things the governments can do, and here the managing director proposes a wise use of public support. For example, when some sectors are helped financially, there could be the help could come, the support could come with green strings attached. So, for example, commitment to reduce emissions, like, for example, the French government did when they promised to help the airline industry. There is another very important thing that governments can do. On the third point, put the right price on carbon. So carbon tax or carbon pricing is something that the fund has always advocated quite strongly, but also important, promote green finance. So of course, this is very, very important. Now that we have defined what is the role of the financial sectors, let's move to what is the role of the central banks. And I will focus in particular on two aspects, analysis and operations. First of all, let's make it clear that climate-related risks are a source of financial risk and therefore fall squarely within the mandates of central banks and supervisors to ensure the financial system is resilient to these risks. Now, I think that this reference to the mandate is extremely important, because this is basically the represent the context, but also the boundary of the action by central banks and also financial regulators. So let's look from a point of view of the analysis. Of course, it's important for central banks to understand the impact of climate change on the conduct of monetary policy. So the impact on the economy at large, output, employment, inflation, savings, investments, because this, of course, is something that will affect the monetary policy itself, its effectiveness, its design, and so on. It's also important to understand what is the nature, persistence, and magnitude of the shocks. So, for example, demand shocks generally are more amenable than supply shocks to effective monetary policy response. So it's important to understand what the shocks are, whether they are temporary or permanent or even persistent. And then again, there's distributional effects. There will be a persistent change to relative prices, which means that there will be winners and there will be losers. It's important to understand who's who. Then there is the policy. So here the picture is a bit more nuanced. So more than policy, let's speak of operations of the banks, because the central banks have operations in terms of monetary policy, but also for their own assets. For example, as was mentioned by the previous speaker, the staff pension funds, and surely they can do all of this in their power to align those investment to, for example, ESG standards. For collateral eligibility criteria and haircuts, here already we must be careful, because certainly something can be done, and but this is really dependent on underlying risks, including climate-related ones. This is very important, because one of the main principles around which that central banks always stick to is the market neutrality. So basically, is not to alter the equilibrium in the market, and this comes to my last point. So what else can they do? Well, certainly there might be other things other actions that the bank can do, but here the magic word is mandate. What is in their mandate? Why is this? Because as public institutions, central banks are expected to be held properly accountable to lawmakers and to society. So this is a bit a fundamental principle of modern central banks in banking that has been shaped and built on in the past at least 40 years. Something that the fund constantly advocates in its article formations, in its technical assistance, in financial stability assessments, because central banks are expected to explain and justify their actions and give account of the decision made in the execution of their responsibilities. That's why they tend to be market neutral, because they cannot pick winners and losers. I mean, it's already quite a problem when governments do pick winners and losers. But you know, that is especially for elected officials, that can be seen as the will of the electorate. But for central banks, this is not the case. So the point is, what can they do? The mandate should say explicitly that central banks can act to favor sustainability, or that they must act to support the policies of the government, and the government might require central banks to act. But without such an endorsement, the central banks cannot act independently. There is an interesting paper by Dicao and Volz on central bank mandates, and they looked at the database of central bank laws and held by the IMF, and they found that only in 12% of the case the central banks have sustainability mandates. So it is important. I mean, there is certainly a shift in opinion on this, and the previous speaker mentioned Christine Lagarde, that also said we are ready to support the efforts of governments, public institutions, the private sector in the greening the recovery, but important, says, in line with our mandate. So the central banks cannot step out of the mandate without compromising their reputation, their independence, their accountability. So this is something important to keep in mind. And this also leads to the next part, which is on financial regulators' role, which I think is quite similar. Peter will speak extensively about this. It's still a matter of mandate, but it's also a matter of international regulatory framework. We have a framework that is based largely on risk. And so whatever is considered risky can receive higher risk weights. This might be the case of brown assets, but it should be justified by riskiness. So let me leave the floor to Peter.
Thank you, Pierpaolo. So I'll start by looking at recommendation 1 from the NGFS guide for supervisors. I'm going to cover this in more detail later, but I think this frames the discussion that's going to happen over the next few slides. So next slide, please. So let's talk about one of the measures that can be promoted by financial regulators, climate-related financial disclosures. First, let's talk about disclosures in general. Disclosures are important for investors, creditors, and other stakeholders. Disclosures inform the value investors attribute to financial instruments issued by companies. They do this by providing information about the profitability of the company, the risks to that profitability, and inform risk pricing. Disclosure informs and supports capital allocation decision by investors and lenders. Many prudential frameworks incorporate what we refer to as a pillar 3 of a prudential framework, disclosures that promote market discipline. Market discipline is achieved through transparency about the governance, strategy, operations, and risk management of a company. This leads to the ability to compare various investment or lending opportunities. More information and transparency leads to improved financial stability. So that is a general case for promoting disclosure. Now to the specifics of climate-related financial disclosures. The Financial Stability Board established the Task Force on Climate-Related Financial Disclosures, commonly known as TCFD, which set out recommendations for climate disclosure. The IMF supports the development and adoption of mandatory climate risk disclosure standards. Developing these standards will be a journey. The first step is to develop principles-based climate risk disclosure standards. These may build on the TCFD recommendations, as they are a well-recognised basis for climate-related disclosures. I'll therefore go through the TCFD recommendations the next slides to give you a flavour for what climate-related disclosures could look like. Discussions have commenced about incorporating climate-related disclosures in standard accounting-based disclosures, specifically in the context of international financial reporting standards, which are adopted widely around the world. Next slide. So the TCFD, go back one to your one's governance, yeah. So there are 4 thematic areas to the TCFD recommendations. In essence, they build on each other and increase in granularity. The 4 thematic areas are governance, strategy, risk management, metrics, and targets. First, let us turn to governance. Climate-related governance disclosures will describe the board's oversight of climate-related risks and opportunities and describe management's role in assessing and managing these risks and opportunities. Climate-related strategy disclosures will then describe climate-related risks and opportunities for the company over the short, medium, and long term. These strategy disclosures will further describe the impact of climate-related risks and opportunity on businesses, strategy, and financial planning of the company. These strategy disclosures should take into consideration different climate-related scenarios, including an increase in global temperatures of 2 degrees Celsius or a less impactful scenario, and describe the resilience strategy of the company. Next slide. Building on these high-level disclosures about governance and strategy, there should be climate-related risk management disclosures. These disclosures will describe processes for identifying and assessing climate-related risks, describe processes for managing those identified climate-related risks, and how those processes are integrated into the overall risk management of the company. Last of all, there should be climate-related metrics and targets. Metrics should be disclosed about how the company assesses climate-related risks and opportunities as set out in the strategy and risk management processes. Importantly, companies should disclose their own greenhouse gas emissions and the risks related to those emissions. The disclosure should set out and describe targets used to manage climate-related risks and opportunities and how the company is performing against those predetermined targets. So moving on to an example of implementation of the TCFD recommendations in the insurance sector. So this sort of sets out how disclosure recommendations from TCFD have been implemented. Well, the outcome has been mixed, to say the least. The Sustainable Insurance Forum, which has been supported by the UN Environment Programme and brings together insurance supervisors willing to discuss how to address climate-related risks, conducted a survey covering 15 jurisdictions with data collected from 1,170 individual insurers. The survey found that 73% of insurers expect climate change will affect their business. It's alarming that 27% think that it won't affect their business. 76% reported they already disclose some information relevant to climate change, but if you dig into these responses, it shows there are very different interpretations of what information they think is relevant to climate change. The most disappointing outcome is that only 20% of insurers have taken action to implement TCFD recommendations. There is much to do with respect to climate-related disclosures in the insurance industry. However, the seemingly poor outcome disguises some more positive aspects. It's important to note that the world's largest insurers are driving action. So in the 15 jurisdictions surveyed, companies representing 60% of total premium volume are taking action to implement TCFD recommendations. So there's a disparity between large and small insurers on the matter of climate-related disclosures. And importantly for this audience today, a third of respondents from large emerging economy insurance markets were not previously aware of TCFD recommendations prior to receiving the survey. That is concerning and points to a need for education of insurers in emerging markets on the topic of climate-related disclosures. So you can learn more from the link that I've provided in the slides there. Next slide. So we have talked about what climate-related disclosures are. Let's now turn to how supervisors could use those climate-related disclosures in their work. Public disclosures are a basis for supervisors to assess the risk of the industry and individual companies in that industry with respect to climate-related risks. However, it is likely supervisors will need additional data that would be considered proprietary and not in the public domain. The public disclosures may point to the likely existence of qualitative and quantitative data, or may show gaps that require supervisors to fill those gaps with requests to report relevant data. Using disclosures and supervisory data, supervisors can look across the industry, apply benchmarking to assess which firms are conducting climate risk assessment, management and mitigation in the most effective way. They can work with their supervised industry to collectively raise the bar with respect to climate-related disclosures, which will have the effect of raising the bar in companies actually managing climate-related risks and opportunities, and therefore positively instituting the necessary change. So moving on to the next slide, previous speaker has actually already introduced the Network for Greening the Financial System. I'll just point out one thing, there is actually 3 African members out of the 66 members, and the IMF is an observer of the NGFS. So in the interest of time, I'll move on to the next slide. In May, the NGFS published its guide for supervisors integrating climate-related and environmental risks into prudential supervision. This is a timely publication, and this will frame further development of supervisors taking into account climate-related risks in their supervisory practices. There are 5 recommendations, and the first is fundamental to the next 4. Recommendation 1 requires supervisors to assess physical and transition risks that we talked about earlier in the presentation. They should do this to determine how climate-related and environmental risks transmit to the economies and financial sectors in their jurisdictions, and they should then identify how material these are likely to be for supervised entities. They will need data to perform this analysis, and this is why it is so important that there are public disclosures and further private reporting of climate-related risks and opportunities. Recommendation 2 relates to the internal organisation of supervisors. Supervisors themselves need to develop a clear strategy, establish an internal organisation, and allocate adequate resources to address climate-related and environmental risk. Climate-related risk assessment has relevance to many departments and experts across supervisory authorities, so they need to have a structure for developing climate-related assessment processes. They need adequate resources to be committed to the task, and they need a commitment from the top of the supervisory authorities. The guide sets out different practices used by supervisors to embed climate-related and environmental risks into their day-to-day work. Next slide, please. Okay, so the third recommendation identifies the exposures of supervised entities that are vulnerable to climate-related environmental risks and assess the potential losses should these risks materialise. This involves determining an approach to gathering data, scenario analysis and stress testing, and the guide actually sets out different practices used by supervisors to identify and assess climate-related and environmental risks. Recommendation 4 sets supervisory expectations to create transparency for financial institutions in relation to the supervisor's understanding of a prudent approach to climate-related and environmental risks. The governance strategy, risk management, scenario analysis and stress testing and disclosure should be set out in line with TCFD. So moving on to the next slide, recommendation 5 is to ensure adequate management of climate-related environmental risks by financial institutions and take mitigating action where appropriate. They should have qualitative measures, including the strengthening of risk management and internal control systems or reduction of risks. And they should have quantitative measures. Now these generally have not yet been imposed by supervisors, as environmental risk quantification is an area that's still being developed, but this is a noted area that needs further development. So, so that leads to the further work that the NTFS has identified. They need to look into data and methodologies for supervisors to improve climate-related environmental risk assessments and investigate transmission channels. Next slide, please. So that leads to setting out some priorities for supervisors and longer-term goals. So immediate priorities relate to supervisory processes. Supervisors can raise awareness of climate risks among supervised entities. They can incorporate climate risks into their stress testing approaches and scenario analysis. They can ensure that Pillar 2 risk analysis includes climate risks, and they can ensure risk management processes acknowledge and incorporate climate risks. Now, we do expect they'll face some resistance due to the time horizon of climate risk versus shorter term focus of supervised entities. In terms of the longer term goals, incorporating climate risks into regulation to ensure climate risk assessment is enforceable and requiring mandatory disclosure. I'm being reminded that time is nearly up, so next slide. I won't go into great detail here because of time, but essentially for insurers and reinsurers, they need to not only reflect on the past in terms of risk, but they need to take into account a forward-looking perspective, taking into account climate modelling and catastrophe modelling. So around the world, some supervisors have a view of trying to discard the outputs from models because they are leading to increased premiums, which can be unpopular amongst people. So it's important that supervisors promote the use of a forward-looking approach to these risks. I will stop there and hand back to Pierre Paolo.
Thank you, Peter. Let me ask to Kwame if we have still 5 minutes to go through the last part, because I'm also very mindful of time.
You've gone a little bit over time, but you can wrap up quickly. No problem.
Oh, okay, thank you. So let me very quickly go through this last part. Here is a statement again by our managing director, just saying that there is no way to address fundamentals of each economy without looking at the climate risks. And here we have a list that I can share with organizers, and they can share with you a list of different publications of the IMF, macrofinancial impact, sustainable finance, mitigation policies. There is the World Economic Outlook, the GFSR we already mentioned, Fiscal Monitor, and so on. Also, I leave a link here about fiscal policy. There is a lot that has been done by the fund in terms of fiscal policy for climate change. As regards financial sector policy, the idea is to promote green finance, support for stronger and possibly mandatory climate-related disclosures, as Peter has just said, and develop climate risk measurement and management in the financial sector. And we do this both in our advice to the member countries, and in our work, for example, collaboration with the Network for Green the Financial System, and participation in other fora like the Financial Stability Board. In terms of the own activity of the fund, the one important aspect is the Article 4 consultations, which are the regular periodic assessment of economic and financial developments of a country in discussion with the authorities. There are certainly macrocritical vulnerabilities that are linked to physical and transition risk, and this will become increasingly part of the conversation. You can, if you're interested, you can have a look at the Article 4 staff reports for Belgium, Botswana, Kuwait of this year, but also many other, especially small state islands. Another very important activity by the fund, and in this case a joint with the World Bank, are the climate change policy assessments. There are assessments introduced on a pilot basis in 2017 to provide an overarching assessment of countries' climate strategies. They are meant to help countries to build a coherent macro framework for responding to climate change. There have been 5 so far, mainly in, there is one for Seychelles, and then the other ones are either Latin America or so Caribbean or Oceania. And then another very important activity by the fund is the financial sector assessment program. This is traditionally based on 3 pillars: risk analysis, financial oversight, safety nets. There is not much that we see the need to do on the third one for the time being, but certainly there is something on the first one, risk analysis, and possibly something also financial oversight. So an idea here is that climate risks could be incorporated in the assessments of compliance with the core principles that our staff and our experts do when they analyze financial oversight in a financial sector assessment. This is not something that is happening yet, but it's something that we can work on. And then for risk analysis, very important, the fulcrum of risk analysis is always generally the stress testing, solvency stress testing, liquidity stress testing. And here we are trying to incorporate the physical risk and transition risk into the into this analysis. You see there are some, there already been some assessment done, especially on physical risk, and more are in the pipeline. Here you see, for example, also the one also for South Africa. And we collaborate with the Network for Green the Financial System on these topics of scenario analysis and stress testing. Finally, let me say on this topic of climate risk stress testing, this is a very important topic, and but it's also a very challenging one. There is the challenge of the horizons, because stress tests typically run on short to medium term horizon, 3 to 5 years. And instead, there is a need to capture risks that tend to materialize over much longer horizons, can be decades. So this is a bit of a challenge. The transmission channels, we already say that there is a complex mix of transmission channels. You think of impacts on coastal properties from flooding, crop yields that can reduce because of increasing temperature, as labor productivity, stranded assets, and so on. Analyzing all these effects, and the transmission channel is quite complex. Feedback effects must be modeled, both of positive sides, so they reinforce the effect, or negative that mitigate them. So as the tipping points, for example, the climate science tells us that there are certain tipping points, which means that things do not increase linearly with the temperature, for example, or with CO2 concentration in the atmosphere, but at a certain point there can be the events that accelerate everything. Like, for example, large parts of ice sheet in Antarctica, on Greenland, start to lose stability. And finally, modeling interconnectedness. This is always true in case of stress testing, scenario analysis, and also combining this physical and transition risk. This is not necessarily trivial. I leave it here, and sorry for having taken a bit longer, and I hope and there will be questions.
Thank you very much, guys, for your very, very, very detailed presentation. I must say I have learned a lot. It was very, very, you're going to share your slides with us, I'm sure. So we would like to use it for reference at a later stage, because it does contain a lot of information. So once again, thank you very much for a well-prepared and a well-delivered set of presentation. Just for the listeners who may have just joined us before we started, our two panelists were Pierpaolo Grippa. He's a senior economist, monetary and capital markets from the International Monetary Fund, and his colleague, Peter Windsor, who's a senior financial sector expert also at the International Monetary Fund. They basically spent about an hour just talking to us about what central banks and regulators can do and actions they can take in sort of building a climate resilient economy. And I think it was quite informative. We've got a number of questions, but because of the detailed nature of your conversation, you've actually, or your presentation, you covered a lot of them, but there are still a few that I'll just like to go through quickly with you guys in the limited time that we've got. The first one is that it is quite clear that there's a shift towards a green economy and the world is decarbonizing, and yet it still appears that green investments do not make economic sense from a risk-reward trade-off point of view without subsidies. Why do you think that is the case, and when do you think that changes?
This is a question. It's also quite difficult to reply. What I know is that traditionally there has been always a very high return on equity in the fossil fuel sector compared to renewables. This is certainly true. But let me also say something that is, we know that from Finance 101 that you cannot look at the return without looking at risk. And risk, you can approximate it by the volatility. And what is becoming increasingly clear for investors is that the volatility of fossil fuel investment, which has always been very high, has become even higher. I mean, like the recent crisis during the lockdown has shown. I mean, oil prices went negative, which was something that was never seen. This has spooked quite a lot of investors. So while until now it was true that some investors were still a bit reluctant to shed fossil fuel assets because they produce a higher return, well, there are two considerations. One, that probably their volatility has increased, but also that the expected return over certain horizons are going to be very low, if not negative. And look at the case of the coal. There are some, before the coronavirus crisis, there were many estimates of peak oil demand. So when the oil demand would reach its apex before starting to decline, and some say, oh, mid 2020s, some mid 2030s, 2040 or something like that. Everyone is now revising these estimates because probably will happen sooner than expected before, because number of reasons. There's more teleworking, less business travel. There are a number of reasons. So I think that the current situation has quite changed the overall outlook.
Okay, now that's a very good point. I'm talking from South Africa, and given our interest in coal, I remember about just about 10 years ago, coal was the hottest thing right now, and pretty much in the space of 10 years, your investment horizon, expected return horizon in coal has pretty much disappeared. So you make a good point. The second question that someone asked is how do poorer countries, specifically the ones you highlighted that have unpreparedness plus high levels of vulnerability, how do these countries insure themselves, for lack of a better manner, put in some financial risk mitigation measures to allow them to deal with some of the impacts that we're getting from the changing climate?
I might take that one to begin with. There are some countries around the world that have been issuing catastrophe bonds. Some of them with the help of the World Bank. So that's one clear way that you can actually develop a financial product that can actually help governments. And similarly,
can you please explain a little bit more of that, what it means for the listeners who are not used to the concept of catastrophe bonds? Maybe just a quick.
Okay, so it's basically a fully collateralized type of insurance product. So investors invest in the catastrophe bond. Usually, that's invested in something like government bonds, and then if an event occurs that is specified in the catastrophe bond, then some of the capital or all of the capital that is invested can be then made available to mitigate losses. So so investors get a higher return on their investment for the possible loss of capital if the event occurs. So that's how a catastrophe bond is structured. Yeah.
Okay. All right. The next thing is, well, let me put it to you anyway. They say that the IMF still funds countries that subsidize fossil fuels. So how does that align with your commitment to a much more greener economy?
Well, I mean, it's also a very good question. You must understand that we are an organization based on our membership, and we always help members when they need help. So we do it irrespective of the political situation, or whenever we find that there is room to help, we do it. And so even countries that are still subsidizing, we do it, and we help trying to use our help to steer policies in a different direction. This is, for example, every time we do lending, there is conditionality. So there are conditions, strings attached to the lending. And what we are trying to do more and more is to ask for the reforms of, for example, fossil fuel subsidies. That said, it's not that easy. Look at the example Ecuador, where the IMF has advocated a reform of subsidies, but then there has been a lot of backlash from the population because this reform was causing a big economic harm for some parts of the population, and it's not something that the fund is not aware of. But at the same time, it is always the government's responsibility then to implement the policy in such a way that it takes into account all the secondary effects that it can have.
Another question I've got is, what are the practical things small countries can do to green their economies and their financial system? So some, maybe 2 or 3 practical things that they can implement.
Well, of course, there are many things that can be done from the point of view of structural policies, industrial policies, fiscal policies. But when it comes to financial sector policy, I think that what we've been discussing applies more or less equally to larger or to smaller countries, because of course it is important to make risks emerge. So basically, the point is that there are certain risks that are not appropriately measured now and managed, and it's important that all financial institutions and financial markets, where there are financial markets, become more and more aware of these risks. So I would say that it's not materially different. Of course, for example, when you have less of the capital markets, maybe you look more at the lending by banks, and you insist more on banks on doing the proper job in terms of screening their climate risks.
If I can just build on that quickly, you know, I went through, you know, the NGFS guide. I mean, making a start is the important thing. As Pierre Pelle said, you know, starting to actually assess these risks, and you know, one tool that is very powerful in terms of trying to identify the risks is stress testing and scenario analysis. So if the supervisors and the central banks get involved in doing that, then they can start to identify the level of risk and educate the financial sector on those issues.
Okay. I mean, a lot of the questions relate to the things that you've highlighted. You know, it's consistently, I've got about 5, 6, 7 topics. Once again, highlighting how can central banks manage, you know, climate risks without, you know, losing legitimacy or without overstretching themselves. You've addressed it, but maybe in closing remarks, can you maybe just in 2, 3 sentences, I know exactly what you said, but maybe the listeners just joined us, you know, just to sum up why this is squarely within their mandate.
Oh yeah, okay. Yeah, as I say, the mandate is the magic word, and it's the one that shields central banks from being accused of undue interference on in the economy or illegitimate actions because they're not elected officers and so on. So there is this pattern that has emerged in the past like 40 years where central bank independence is a very important independence is a very important aspect of central bank's way of operating, and to protect that, the best thing is to make the mandate clear. So it's not if the mandate says that the central banks needs to support the policies of the government in improving sustainability, that's fine. I mean, it's a decision by the government that the central banks does that. It's dangerous when the central bank starts to pick winners and losers because it decides that it will buy only green assets versus brown assets. We saw that in the presentation that there is still not clear definition of green and brown. So apart from being distortionary, it could be wrong because maybe a central bank could end up buying green assets that are greenwashed, so really brown. So I mean, there are so many problems in doing something stepping out of the mandate, that I would strongly advise against doing it, instead being sure that the mandate ensure any action of this kind. That said, it remains true that from an analytical point of view, the central banks must do all that they can to understand. So in terms of understanding of what is the impact of climate change, absolutely do everything. But in terms of the policy, that's a different matter.
Okay. All right, gentlemen, thank you very much for your time, and thank you very much for your presentations. We've really enjoyed it, and yeah, I'm sure we'll keep in touch.
Okay, thank you very much.
And cheers to our listeners as well.
Thank you.
Thank you. Cheers. Bye.